When examining Iraq's currency strategy, the 1300 Iraqi dinar per US dollar rate stands out as one of the most important factual anchors in the entire financial framework. This rate is not symbolic and it is not temporary. It is the official benchmark used for government budgeting, public sector salaries, imports, and long-term fiscal planning. By structuring national finances around 1300 IQD USD, Iraqi policymakers signal a clear preference for predictability and control rather than short-term market reactions. For investors, this matters because currencies tied to disciplined fiscal planning tend to experience fewer surprise shocks. The rate functions as a policy reference point that allows authorities to manage expectations and maintain economic stability. At the same time, investors are well aware that market rates have traded above the official level. In recent periods, parallel market pricing has often fluctuated in a higher range, commonly between 1,420 and 1,480 IQD per dollar, depending on liquidity conditions and dollar availability. This gap is not ignored by policymakers. Instead, it highlights pressure points within the system, such as demand for hard currency, trade settlement inefficiencies, or compliance tightening within the banking sector. Importantly, the existence of a spread does not automatically indicate policy failure. In many emerging economies, parallel markets reflect transitional friction rather than instability. What matters to investors is whether the official rate remains credible and consistently defended. The continued reliance on a 300 IQD USD suggests that authorities view this level as sustainable under current economic conditions, particularly when supported by oil-driven dollar inflows. Iraq exports more than 3 million barrels of oil per day, generating substantial foreign currency revenue that reinforces reserve buffers and supports exchange rate management. This revenue base gives policymakers flexibility to manage pressures without resorting to abrupt currency adjustments. Inflation control further explains this strategy. Any sudden change to the official rate would immediately raise import costs and consumer prices, placing pressure on households and public spending. By holding the line at 1,300, authorities limit imported inflation and preserve purchasing power. For investors, the message behind the rate is not about predicting appreciation or devaluation, but about intent. The 1,300 IQD rate signals that Iraq's currency strategy prioritizes stability, gradual adjustment, and institutional credibility over speculation. Another key insight investors draw from the 1,300 IQD per US dollar rate is how it reflects Iraq's broader approach to managing currency pressure without surrendering policy control. Rather than allowing short-term market stress to dictate official policy, Iraqi authorities have chosen to treat the exchange rate as a stabilizing anchor while addressing underlying causes of distortion separately. This is evident in how the gap between the official rate and the parallel market rate has been handled. When unofficial rates moved into the 1,421 to IQD per dollar range, the response was not an immediate adjustment of the official rate, but tighter oversight of dollar flows, changes in foreign transfer procedures, and increased enforcement within the banking system. For investors, this signals that policymakers are attempting to correct behavioral and structural issues instead of redefining the currency framework itself. Liquidity management plays a central role here. Iraq's economy remains heavily dollarized, meaning demand for US dollars rises quickly during periods of uncertainty. Rather than allowing this demand to freely reprice the official exchange rate, the central bank has relied on controlled dollar sales and regulatory tools to manage access. This approach aligns with how many resource-based economies protect currency stability while transitioning toward more regulated financial systems. Investors recognize that allowing unrestricted access to dollars can quickly undermine reserves and confidence. By maintaining the 1,300 IQD USD benchmark, Iraq preserves a clear reference point while working to channel demand through formal banking mechanisms. This is not a fast process, but it is a deliberate one. Another fact investors consider is how the official rate interacts with government finances and inflation expectations, because public sector wages, pensions, and major contracts are calculated using the official rate. Maintaining stability at 1,300 helps prevent sudden fiscal imbalances. A weaker official rate would immediately increase the local currency cost of imports and government obligations, potentially pushing inflation higher. For a country where imported goods represent a significant share of consumption, this risk is substantial. By keeping the official rate unchanged, authorities limit the pass-through of currency pressure into consumer prices. This restraint is often overlooked in online discussions, but it is highly relevant to institutional investors who factor social and political stability into currency risk assessments. Investors also see the 1E300 rate as evidence that Iraq is sequencing reform rather than rushing it. Instead of using the exchange rate as a shortcut to resolve structural problems, policymakers appear focused on improving compliance, transparency, and financial discipline first. From an investment perspective, this sequencing matters. A third message investors take from the 1-300 IQD per dollar framework is how closely it is tied to Iraq's reserve strength and oil-based revenue cycle, which together form the financial backbone supporting currency stability. Iraq's foreign currency reserves are largely replenished through oil exports, which consistently exceed 3 million barrels per day and generate billions of dollars in monthly inflows when prices remain within moderate ranges. These inflows allow the central bank to supply dollars to the domestic market, support government spending, and maintain confidence in the official exchange rate, even when market pressures emerge. Investors pay close attention to this linkage because a fixed or managed exchange rate is only credible if it is backed by sufficient reserves. The continued defense of the 1-300 IQD rate suggests that policymakers believe reserve coverage remains adequate to support current obligations and manage volatility without resorting to abrupt currency adjustments. At the same time, investors recognize that reserve strength is not static. It must be preserved through discipline. This is why Iraq's approach to managing dollar demand is viewed as part of the currency strategy rather than a separate issue. When parallel market rates rise into the 1-420-1-480 IQD range, it signals excess demand for dollars outside formal channels. Instead of responding by weakening the official rate, authorities have focused on narrowing the gap by regulating access and improving transparency. From an investor's perspective, this reflects an understanding that preserving reserves is as important as defending the headline rate. A country that exhausts reserves to maintain an exchange rate loses credibility quickly, while a country that balances supply with discipline maintains flexibility. Iraq's current posture appears aimed at avoiding the former. Another factor investors monitor is how oil price fluctuations translate into currency policy decisions. In many commodity-dependent economies, currency volatility closely follows commodity price swings. Iraq's decision to maintain a stable official rate despite oil price cycles signals an effort to decouple short-term revenue volatility from monetary policy. This matters because it reduces the risk of pro-cyclical currency moves, situations where falling oil prices force immediate devaluation, worsening inflation and economic stress. By keeping the 1,300 IQD benchmark intact during both stronger and weaker oil periods, policymakers communicate that the exchange rate is not being used as a shock absorber of first resort. Investors generally view this restraint positively, especially when reserve levels provide a cushion. A fourth insight investors derive from the 1-300 IQD per US dollar rate is how it reflects Iraq's emphasis on institutional coordination and policy credibility, rather than reactive decision-making. Exchange rates are ultimately a reflection of governance, and investors closely watch whether monetary policy, fiscal policy, and banking regulation move in the same direction. In Iraq's case, the continued use of the 1-300 rate across government budgets, public sector payrolls, and official financial reporting suggests alignment between the central bank and fiscal authorities. This coordination is not accidental. When institutions operate with conflicting assumptions, currencies become vulnerable to sudden shocks. By anchoring multiple policy areas to the same exchange rate framework, Iraq reduces internal contradictions that can undermine confidence. Another fact investors pay attention to is how policy communication has evolved. In the past, mixed messaging or abrupt shifts fueled uncertainty and speculation. More recently, authorities have emphasized consistency, repeating the same exchange rate position while focusing public communication on regulation, compliance, and gradual normalization. From an investor's perspective, this matters because markets react as much to how policies are communicated as to the policies themselves. Stable messaging reduces the likelihood of panic-driven behavior in currency markets. Even when parallel rates fluctuate above official levels, the absence of sudden reversals or conflicting statements helps anchor expectations. Investors interpret this as a sign that policymakers are confident in their framework and prepared to manage pressure without abandoning it. The banking sector also plays a critical role in reinforcing this credibility. Investors observe how commercial banks adapt to tighter compliance standards, international transfer rules, and documentation requirements. While these measures can slow transactions and create short-term friction, they are viewed as necessary steps toward a more regulated and transparent system. A banking environment that operates under clearer rules reduces the risk of uncontrolled dollar leakage and speculative pressure on the currency. Iraq's efforts to expand electronic payments, reduce reliance on cash, and integrate banks more deeply into formal dollar channels support the sustainability of the 1-300 rate. These are not headline-grabbing reforms, but they strengthen the foundation beneath the exchange rate policy. Finally, investors assess whether currency policy appears institutionalized rather than personality-driven. Stability is far more durable when it is embedded in systems, procedures, and regulations rather than dependent on individual decisions. The persistence of the 1-300 IQD framework across political cycles and periods of economic stress suggests movement toward institutional continuity. The final takeaway investors draw from the 1-300 IQD per US dollar rate is how it shapes expectations, risk assessment, and long-term positioning, which ultimately matters more than short-term market fluctuations. In currency markets, credibility is built when authorities demonstrate that they can manage pressure without resorting to abrupt or politically driven decisions. By maintaining the 1-300 rate as the official anchor, despite periods when parallel market rates move higher, Iraq signals that exchange rate policy is being guided by capacity and discipline rather than sentiment. Investors understand that expectation management is a core function of monetary policy. When expectations become unanchored, even strong fundamentals can be overwhelmed by speculation. The consistent reinforcement of the 1-300 framework helps prevent that outcome by setting a clear boundary around what the system is designed to support. Another fact investors consider is how this approach affects capital planning and modeling. Long-term investors, banks, and institutions require stable assumptions to evaluate risk, returns, and exposure. A clearly defined official rate allows them to model Iraq's economy with greater confidence, even if short-term market noise persists. Sudden devaluations or frequent policy shifts make accurate modeling difficult and raise risk premiums. By contrast, a stable benchmark, even one that coexists with a parallel market, provides a reference point for decision-making. This is why many investors are less focused on closing the spread immediately and more focused on whether the framework remains intact over time. The 1-300 rate also signals that Iraq is prioritizing social and economic stability alongside financial considerations. Exchange rate shocks often translate quickly into higher food, fuel, and import prices, which constrain household budgets and public finances. By avoiding abrupt changes, authorities reduce the risk of inflationary spikes and preserve purchasing power. Investors factor this into their assessments because social stability influences political risk, and political risk directly affects currency confidence. A currency strategy that minimizes social disruption is more likely to endure, even if it advances slowly. In the end, what the 1-300 IQD rate tells investors is not that Iraq is resisting change, but that it is sequencing it carefully. The strategy reflects an understanding that durable currency credibility is built through institutions, reserves, disciplined fiscal planning, and consistent policy behavior. For investors, this approach suggests direction rather than destination. It indicates that Iraq is focused on maintaining control today so that future adjustments, if and when they occur, happen from a position of strength rather than pressure. That mindset, more than any headline or rumor, is what keeps serious investors watching closely.